Hi everyone, my name is Jihan. My group members are Susma and Soraya. Today, our group is here to do the presentation about the Coles accounting practice. First, I will give a brief introduction. Coles is one of the largest retailers in Australia. Next slide, please. It is a listed company on Australian Securities Exchange, follows the accounting and disclosure rules. To provide a better understanding of this topic, we are going to conduct a detailed analysis from these three key aspects as below: impairment of assets, contingent liabilities, and the financial instruments. During our analysis, we found some challenges in these three areas and also provide some recommendations at the end. Now, I will start from the Coles approach to impairment of assets. Moving to the next slide. The company applies AASB 136, which sets out the rules for recognizing and measuring impairment. According to the standard, assets must be tested for impairment whenever there are indicators that their carrying amount may not be recoverable. For intangible assets with indefinite useful lives, and for goodwill, the test must occur annually regardless of whether there are signs for impairment. The recoverable amount is calculated as the higher of two values, the asset value in use or its fair value less cost of disposal. This ensures that assets are not overstated and fairly presented on the balance sheet. For the next slides, when we focus on the goodwill, it is allocated to cash generating units or CGUS, which represent the smallest group of assets monitored by management for internal reporting. As disclosed in annual report of 2024, Coles tests goodwill for impairment every year. The method used is the discounted cash flow model, where management forecasts future cash inflows for each CGU and then discuss those flows back to present value. The important point is that impairment losses on goodwill cannot be reversed in subsequent periods. Once a write-down has occurred, the reduced carrying value is permanent. This is a key difference from other non-financial assets, which I will discuss in the next slides. The property, plant, equipment, and intangible assets with finite lives for Coles are tested for impairment whenever there is an indication that their values may have declined. If an impairment is identified, the loss is recorded in the income statement and the assets carrying amount is reduced accordingly. In contrast to goodwill, impairment losses on its assets may reverse if circumstances improve. However, the reversal is limited. The assets cannot be increased beyond the carrying amount. It would have had if no impairment had been recognized. After depreciation or amortization, in the case of trade receivables, Coles continuously assesses collectability and rest of balances once they are identified as uncollectible. Next, Susma will talk about the part of the contingent liabilities. Thanks.
Thank you, Sian. Coles applies AASB 137 provisions, contingent liabilities, and contingent assets. According to AASB 2019, the portion of an obligation that is anticipated to be fulfilled by third parties is regarded as a contingent liability when an entity is held jointly and severally liable for it. Except in a very rare cases where a precise estimate cannot be made, the entity recognizes a provision for the portion of the obligation for which an outflow of resources representing economic benefits is likely. As of 30 June 2024, Coles reported no contingent liabilities in the financial statement, but significant matters were disclosed in the notes. These disclosures are important because they highlight potential financial obligations that could affect Coles' future performance. Now going to the recognition and disclosure of significant contingent liabilities. The first is the self-initiated remuneration review under the General Retail Industry Award 2010. Coles identified problems, self-reviewed, and discovered that 15,011 team members had been underpaid. In response, voluntarily paid $31 million to affected staff and recorded a provision of $19 million in the 2024 financial statement. This shows Cole's willingness to recognize responsibility. The second is the Fair Work Ombudsman FWO claim. The FWO has alleged that Coles underpaid 7,687 employees and has to pay an additional $108 million. However, this matter is still on courts and hasn't been finalized by courts. The outcome remains uncertain. Coles has disclosed the claim in its notes but has not recognized it in financial statement. This is consistent with the accounting standard, which requires recognition only when an obligation is probable and can be reliably estimated. The third is a class action lawsuit, similar to FWO claim, which was filed by supermarket managers on May 2020, claiming to be underpaid. This case is ongoing, with no clear estimate of the potential financial impacts. As a result, Coles has only disclosed the lawsuit in its notes, rather than recognizing it as a liability. Moving to the next slide. Now I'm going to discuss about the challenges in estimating contingent liabilities, especially concerning legal or regulatory uncertainties. First is legal uncertainty. Court cases and regulatory investigation often involve different interpretation of employment law, meaning the outcome are highly unpredictable. For example, Coles self-reviewed and paid the remuneration of 15,011 team members, but FWO claims a different interpretation of our amounting $108 million. Second is the difficulty in estimating potential financial impact. It is extremely challenging to determine the financial impact of cases like this because penalties, legal fees, and settlement amount may vary significantly from expectation. For example, Coles has recognized a provision of $19 million. FWO alleged that Coles is obligated to pay a further $108 million in a remediation payment to 7,687 team members for the period. Third is timing uncertainty. Legal proceeding can stretch across many financial years, making it difficult for companies like Coles to plan accurately. For example, the FWO matter was heard in a 7-week trial from 5th June 2023 and judgment is pending. Finally, interdependence with other risks and uncertainties. An occurrence of one event can trigger occurrence of multiple overlapping possible contingent liabilities. For example, FWO alleged Coles for the obligation to pay team member after that class action lawsuit was filed against Coles for underpaying managers. Both cases are likely to be linked but are pursued independent. Now, next slide is going to describe by Saurya.
Thank you, Susma. Now I am presenting Coles Group Limited's treatment of financial instrument in 2024 in line with AASB 9 Financial Instrument, AASB 7 Financial Instrument Disclosure, and AASB 132 Financial Instrument Presentation. Now moving to the next slide. Let's begin with the types and classification of financial instruments. Ordinary shares are classified as equity instruments. Coles is publicly listed on ASX under the dividend investment plan. Shareholders can convert dividends into more shares. DRPs impact equity, but AASB 9 does not classify them as financial instruments. Debt instruments include the $600 million medium-term note issued in November 2023 as part of Coles' $1.65 billion capital market debt. These are categorized as financial liabilities at amortized cost according to AASB 9. Their fair value was slightly lower at $1.547 billion. Lease liabilities due to Coles' large store network are accounted for under AASB 16. These are valued at amortized cost and are the significant part of company's funding structure. Loans and credit facilities, such as revolving credit and bank loans, are used for strategic expansion and operating capital. These are also valued at amortized cost. Trade receivable and payables are short-term instruments representing significant working capital flows. They are valued at amortized cost and adjusted where enforceable netting agreements are in place. Now moving to the next slide. Derivatives used by Coles include forward contract, interest rate swaps, electricity swaps, and power purchase agreement. These are primarily for hedging. For cash flow hedges, Coles use derivatives to reduce exposure to interest rate, foreign exchange, and energy cost. Effective changes in fair value are recorded in OCI and added to the hedging reserve. For fair value hedge, Coles hedge against fluctuation in the fair value of fixed rate debt. Changes in both the derivatives and hedge items' fair values are recorded in profit or loss. Regarding fair value assessment, Coles applies AASB 13's fair value hierarchy. Label 1 hierarchy shows quoted price in active market. Label 2 observable market data like forward prices and interest rate curves. Label 3 unobservable inputs such as PPAs with forecasted electricity cost. In 2024, Coles reported derivative asset of $29 million and derivative liabilities of $9 million. The majority are labeled to instruments like FX contracts and interest rate swaps. PPAs are label 3. So now moving to the next slide. For financial risk management, Coles discloses under AASB 7. Credit risks. Coles reduce counterparty risks by doing business with investment-grade organizations. Projected credit loss models are used to track trade receivables under AASB 9. For liquidity risks, Coles manages short-term commitments using cash on hand and undrawn facilities. Market risks. Energy price risk is hedged under PPAs and power swaps, reflecting a strategic move towards sustainability. Now, the next part will be presented by Sihan. Thanks.
Okay, thanks, Gloria. Now, let's talk about some challenges in determining recoverable amount for impairment, as it involves considerable judgment and subjectivity. The recoverable amount often depends on level 3 fair value inputs, which are unobservable and therefore highly subjective. Forecasting future cash flows is inherently uncertain, and it requires management to predict consumer demand, economic conditions, and operating performance as well. Determining of discount rates and terminal growth rate is equally challenging, as even small changes can significantly affect the valuations. These factors thus cause the estimation uncertainty. Then, external factors can affect the impairment as well. Firstly, rising interest rates increase the discount rates in the cash flow models, which in return reduce the recoverable amounts. Likewise, the market competition and rapid shifts in consumer preferences also affect the revenue forecast. And finally, inflationary pressure and supply chain disruptions also increase the risk of the impairment. Based on the above analysis, some of the recommendations will be given to improve the financial reporting and risk management for Coles impairment approach. Coles can enhance the transparency by providing more detailed disclosures about the assumptions used, such as discount rate and growth forecast. Also, Coles should include sensitivity analysis to show how small changes to discount rate growth rate affect impairment. In addition, Coles can take help or engage independent valuation experts in order to reduce management bias and subjectivity. Finally, it must have the effective risk monitoring in place regarding the external environment factors. All these measures combined would enhance the reliability of the impairment assessments and this disclosure by Coles. Then, Susma will continue with the challenges and the recommendations in contingent liability parts. Thanks.
Thank you, Sihan. On this slide, I'm going to explain about challenges and recommendations depending on contingent liabilities. First, there is uncertainty in estimating liabilities. The FWO claims that Coles may owe $108 million, but Coles has only provisioned $19 million based on their research. They must constantly reevaluate the provisions estimate as the case progresses. Second, there is the complexity of probability assessment. Coles believe the $108 million claim is not likely, so they don't record it as a provision, but they still disclose it as a possibility liability. Third, FWO claim creates a volatility in reporting. If the court rules against them, Coles would certainly have to record the $108 million as provision, which would definitely increase their liabilities. Finally, there is a risk to reputation. Even before any legal decision is made, ongoing claims of underpayment can damage Coles' image and undermine its strategic goal of being seen as a trusted Australian retailer. My recommendation is that Coles should strengthen legal analysis, use scenario planning, and improve internal control to track risks early. They should also work more closely with the regulators to prevent dispute from escalating. Now, next slide is going to explain by Saurya.
Thank you, Susma. Now, the Coles faces several key challenges in managing its financial instruments. It is difficult to predict future electricity rates for long-term energy contracts due to market and government changes. Strict regulation and frequent audits make it hard to prove his effectiveness. Valuation changes can cause profit fluctuation, and while Coles follows the rules and reports accurately, it should be more transparent about its assumption. The recommendation includes there needs to be more transparency in how complex tools like PPAs are valued, and his accounting disclosure should clearly show how effective the hedging is. We need to regularly review our valuation methods to keep up with market changes and ongoing training in risk management, and his accounting is essential for our finance team. Moving to the next slide. To conclude, Coles holds to Australian accounting standards in managing asset impairment, contingent liabilities, and financial instruments, ensuring compliance and transparency. However, significant challenges arise from judgment-based assumption in impairment testing. Legal uncertainties surrounding contingent liabilities such as the FWO claim and valuation complexities of Level 3 instruments like PPAs. These areas create financial volatility and reputational risks. To address this, Coles should enhance transparency in its assumption, adopt independent reviews, strengthen governance frameworks, and provide clearer disclosures. Such improvements will not only increase the reliability of financial reporting, but also reinforce investment confidence and stakeholder trust in the company. This is the end of our presentation. Thank you.
Thank you.
Thank you.